Good morning, good afternoon, good evening, wherever you are in the world. Welcome to our 12th Signature FX episode on this, the 20th of March, 2018. It's our follow-up video to our episode 11 video on none other than Bitcoin. Signature FX is yours truly, Marley Holiday and Andrew Ibrahim, and we always like to kick off our videos with a thoughtful quote. Today's insightful quote comes from Joyce Meyer. This Joyce Meyer quote goes like this: "Patience is not simply the ability to wait, it's how we behave while we're waiting." Now, this quote is important for many reasons. Ask yourself, what do you do when you're waiting for something? If your thoughts are negative and your mind is pessimistic, thinking that you'll be wrong, then chances are you'll get impatient and you'll make an emotional decision. This is the worst thing you could do, especially when it comes to trading. You always want to take your emotions out of trading as much as possible. We're going to be referring back to this Joyce Meyer quote throughout the video, but we want to take a moment to talk a little bit about Signature FX. With these videos, we are offering you a completely free service to help you to reach your trading goals, no matter what they may be. There are viewers of varying skill levels watching this video, and we have tried our best to craft the content in a way that is suitable for everyone. Please remember that this is not financial advice. Please conduct your own technical analysis and seek your own independent financial advisor before investing. I, Marley Holiday, personally have over 15 years experience conducting technical analysis in the financial markets, and that amounts to a lot of time analyzing charts and building up what I like to call screen time. Screen time is something that I cannot give you. It's something that you're going to have to work at, and if you don't have it, you're going to have to put in the time looking at charts, analyzing different patterns in order to achieve it. One thing that I've learned in my many hours of screen time looking at the charts, looking at the patterns, is that you need to develop your own trading plan. Now, I've had quite a few people come up to me and say, "Look, Marley, I'm really interested in this investing thing, this trading thing, but I'm not there yet. I don't know the technical analysis." And you know what I say to them? Look, you may not think that you're there yet, but one of the most important first steps is developing your trading plan or your trading system or your trading code, whatever you want to call it. You may be asking yourself, why do I want to develop a trading plan or trading system? The reason is simple: consistency. Going back to the Joyce Meyer quote at the beginning, on focusing on what you're doing while you're being patient. A trading system gives you something productive to do while you're waiting. You have to be able to adapt your lifestyle to make your trading better. Trading isn't for everyone, just like being a doctor isn't for everyone. You have to be relaxed all the time, and you have to be living in the moment. Whoa, I know what you're thinking. Look, Marley, I like all this trading plan stuff, sounds great, but it sounds like a lot of work. I don't want to put that time in. Just tell me where to buy Bitcoin so I can go on to the next YouTube video. And that's what you're thinking, right? Some of you are. Now, I said earlier, I have over 15 years experience investing Forex. That's where I started, and stocks and commodities. And it's not that easy. You can go on YouTube and look at another 20 videos, and each person is probably going to tell you a different place or a different price to buy Bitcoin and what they think Bitcoin's going to do. I'm here to try and help you to develop a trading system that allows you to depend on yourself, rely on yourself to analyze the markets for yourself. You can always look at what other people are suggesting or look at other people's opinions, but you're not relying on them. You're not blindly going onto your favorite YouTube channel and doing exactly what they're telling you to do. Because you know what? It's your savings. It's your hard-earned salary. It's your money that you're going to be putting into these exchanges and purchasing these cryptocurrencies. So why not take responsibility and try and grow it as a career or as a side job or even as a hobby? And that's why we started Signature FX. I am a trading coach, and my job is to allow you to be independent, to think on your own, to analyze the markets with your own knowledge and your own skill set, not to rely on such and such as YouTube posts and you're waiting and relying on them for your every decision. If you're able to develop your own trading system, then you're unstoppable. There's a very old quote that goes like this: "You can give a man a fish and feed him for a day, or you can teach a man to fish and he can feed his family for a lifetime." What these YouTubers are doing are giving you a fish a day, and you have to come back, and you have to come back, and you have to come back. Why not buy a fishing rod and some fishing line, some fishing hooks and some bait, and go and fish for yourself and learn how to do it yourself? Because anything that is too good to be true, or anything that is too easy, is not worth it. A trading system helps you to develop your self-awareness, and this is so incredibly important. When developing a trading system, there are 4 things to consider. Number 1 is how to place your order. You should have a step-by-step process on how to enter and how to exit your trades. Most people use market orders, but I would suggest learning more about buy limit orders if you haven't already, and also using stop losses. Number 2, game theory. Game theory is a very, very deep topic, but essentially it's developing a step process on when this happens, that happens. When negative news comes out about Bitcoin, then I trade this way, or I don't trade at all. Or on the weekends, I don't trade. Whatever it is, have a system in place that allows for when this happens, that happens. Number 3, probability. With probability, you want to work out what the odds are that your trade is going to be successful. One helpful tool is Fibonacci. Another is Elliott wave. Another is moving averages. Another is stochastics. Another is RSI. And another is parabolic SAR. We're going to touch on Fibonacci very briefly a little bit later in this video, but the rest of them you can find in our future videos, which we are diligently working on for Signature FX Academy. Number 4, psychology. This is probably the hardest one to kind of describe to you in such a short period of time. But one of the ways I like to think about psychology is that there's always someone on the opposite side of your trade. So if you're very bullish on Bitcoin, you think it's going to go up, there are hedge funds and there are institutional investors who are thinking of ways to get Bitcoin to go down. And having that awareness and the ability to at least consider the other side of the coin helps you in your ability to review your trades, analyze the markets, and make an informed decision when investing. Let's switch gears now and focus on technical analysis. If you've decided that you'd like to develop yourself as a trader and not just rely on other people's decisions and other people's analysis, then one of the things that you should be considering is developing your own Fibonacci strategy. What is Fibonacci and why does it work? Well, the Fibonacci sequence was first described by Indian mathematicians 1300 years ago. This was first introduced to the West in 12,012 by Leonardo of Pisa, also known as Fibonacci. He also is responsible for introducing Arabic numerals to Europe. In his book, Liberici, he described this sequence. What is the Fibonacci sequence? Let's imagine a sequence of numbers that begin with a number 1, and the second number is also 1. And going forward, every next number is equal to the sum of the previous 2 numbers. So the next number in this case will be 1 plus 1, which is 2. The next number in this sequence is 1 plus 2, which is 3. The next number is 2 plus 3, which is 5. The next number is 3 plus 5, 8. The next number is 13, and so on and so forth, adding the numbers together. In addition to the numbers themselves, you also see the same ratio between Fibonacci numbers. When you divide almost any Fibonacci number by the number before it in the sequence, especially the larger numbers, you get the same number, 1.618. The Greeks discovered this long before Fibonacci, and they called this phi. 1 divided by 1 is 1, 2 divided by 1 is 2, 3 divided by 2 is 1.5, 5 divided by 3 is 1.66. 8 divided by 5 is 1.6. 13 divided by 8 is 1.625. 21 divided by 13 is 1.615. 34 divided by 21 is 1.619. You notice that the numbers are getting closer and closer to 1.618. I was talking to an old friend, and he was saying that he has a bit of experience investing, and he doesn't really trust Fibonacci. He thinks it's smoke and mirrors. He thinks it's a lot of kind of like lucky guesses and coincidences. But let's have a look at where you can see examples of the golden ratio in real life. If you measure the distance between the edge of your fingertips and your wrist, and then you measure the distance between your wrist and your elbow, it will be approximately 1.618. Okay, that could be coincidental, that could just be a one-off. Let's try the phalanges on your fingers. They have the same ratio of the Fibonacci numbers, 2, 3, 5, 8. If you take any starfish and you take the distance between its base as 1, then you take the distance between these two limbs, that will be 1.618. Another example is the Fibonacci spiral, which is constructed of Fibonacci numbers. The Fibonacci spiral is found all over the universe, in many places, in nature, in the real world, and in space. A lot of shells follow the Fibonacci spiral, and some galaxies also. If the Fibonacci numbers appear naturally in nature, how does this apply to trading? Very often you'll find if you measure the distance of your trend and take it as 1 unit, and then measure the distance that the price traveled during the retracement phase, you will often notice that the retracement is equal to 0.618 units. Now, if you divide 1 by the golden ratio, so that's 1 divided by 1.618, you will get 0.618. You might be thinking, okay, how do I use this in my trading? I still don't really understand. How am I using this in my trading? Well, let's assume that you don't know what the price is going to do in the future. Let's say that you're in the middle of an uptrend and you start to see a bit of a retracement happening, but you don't know where the retracement will stop. Now that you know what the golden ratio is, you can predict that there will be a significant chance that the price will go down just as far as 0.618. And to profit from that, you can enter in a sell order at the red arrow, and then enter a buy order at the blue arrow, which is the 0.618, once the retracement has completed. Knowing that you have a very high chance that the trend will continue once it hits 0.618. There's another property in these numbers that if you divide any number by the next number along in the sequence, it will tend towards or get closer to 0.618. Any number divided by the number 2 along, for example, 8 divided by 21, in this example, the results get closer to 0.382. Now, if you take any number and divide it by the number 3 along or 3 ahead, for example, 8 divided by 34, the result gets closer and closer to 0.236. Now, 0.236 and 0.328 are another 2 key numbers in the trading Fibonacci sequences, or the trading Fibonacci numbers. Then if you go right to the beginning of the sequence, you have the numbers 1 and the numbers 2, which equal 1 divided by 2 is 0.5. What technical analysts like myself do is we convert these into percentages. 0.236 becomes 23.6%. 0.382 becomes 38.2%, and 0.5 becomes 50%. The 0.618 becomes 61.8%. From a charting point of view, these are important because they are key Fibonacci retracement levels. These are considered hidden levels of support in an uptrend and, conversely, hidden levels of resistance in a downtrend. And now, without further ado, it's my honor to present to you our Signature FX deep dive technical analysis on Bitcoin. The current time is 9:46 on this Tuesday, the 20th of March, 2018. And I'm going to start off by saying I think we got this call pretty spot on. Okay, going back to the patience quote by Joyce Mayer, we were making a call around here. February 11th was our technical analysis on Bitcoin, our episode 11 video. And if you haven't watched our episode 11 video, I highly suggest that you do take the time to just watch it and see what we were looking at back in the beginning of February. So February 11th, this was where the price was, and what we were calling for based on our Fibonacci and our other instruments. We were looking at Bitcoin dropping lower, and we were going to get in if we had, hypothetically, a balance of $10,000. We were going to put 5% of that into a Bitcoin buy limit order at $7,000, and we were calling that Project Afro. And then we said if the price drops further to $6,000, we would get in another 5%, and we'd call that Project Bermuda, and the price of Project Bermuda would be entering around $6,000. And then lastly but not leastly, we had a Project Crypto, which was the last 5% or a further 5% at $5,000. And that was kind of how we set it out. The market did not go down to our entry, so we're not in. We haven't actually purchased anything. We're still waiting. We still have these 1, 2, 3 buy limit orders pending and waiting to get triggered. But what happened was very interesting because we got the price to shoot up, and there was a tendency in the past when I first started trading to kind of chase the market. And what I was thinking was, okay, the price is going up. I said, buy at 7,000, 6,000, and 5,000. But my entries aren't getting in. I'm going to miss this rocket ship that's about to take off. But I looked at my trading plan and I said, you know what? I'm not going to chase this market. I'm not. If I don't get in where I need to get in, then I'll assess the situation in the future. But at the same time, I was looking at my technical analysis. So in line with the Joyce Mayer quote, as the price was going up, I was being patient. I wasn't getting impatient. I wasn't getting greedy. I wasn't getting emotional. And I wasn't feeling like I'm really missing out on this situation. And sure enough, what happened is the price came back down. Essentially, we're in the same price. If you look at the February 11th video, the price was hovering around this same level. I want to say it was slightly lower during that video. I haven't watched it, but I want to say we were around this same neighborhood, essentially. And to kind of summarize what my outlook is still the same. My outlook is exactly still the same. And I'm going to show you why. Okay, the first thing that we'll look at, we talked about Fibonacci, and we talked about making sure that you understand the concept of Fibonacci, but also the fact that there are other tools that we use along with Fibonacci. One of the things that we've included in this chart is these 3 moving averages, exponential moving averages. So we have the 50-day, the 100-day, and the 200-day exponential moving averages that give an indication of where the price has been. And essentially, when you see things like crossovers where the red line crosses over the yellow line here, then that's a sign that prices potentially could go lower. And the same is true for if the red line crosses this green line, or if the yellow line crosses this green line as well. So these are things that we're going to be looking at as well, and we will touch on them in our Signature FX Academy videos. Don't have that much time in this video to go into detail on that, but what we do have time to do is look at something that I like to call setting your trap. Okay, other traders call it different things. You can call it a setup, you can call it a kill zone. It's essentially where you think that the price is going to go to and then reverse. Okay, so the first thing we're going to do is we're going to take our trading view and we're going to click on Fibonacci retracement. Once you click on Fibonacci retracement, the key is to select your low. Okay, so I like to go to the lowest of lows in a time frame. We're looking at the daily. So on this daily, the lowest of the low is here back in September 14th, 2017, and then the high would be on December 17th, it looks like here. Okay, and once you click off there, that's your Fibonacci done. These are the Fibonacci ratios that we were looking at in the Fibonacci section of this video. So we have the 0.618 comes up automatically, and we are right below that 618 Fibonacci ratio level. Then we also have the 50%, which is essentially 50% from here, which was the low to the high. We have the 38.2% and the 23.6%. The 61.8% is that key level that everybody looks at. But the fact that everybody's looking at it, I mean, you got to bounce off of this here, and then you got a big drop, a break through that 61.8. And essentially, you don't want to be the tourist who is experimenting with the 61.8. I like to use the 78.6 or the 88.6% pullback levels. And these are the levels that the institutional investors are using, the hedge funds are using, the robots are using, the really intellectual big money investors are not looking at the 61.8. The 61.8 is essentially considered expensive, or it's considered the trap of the gullible newbie trader. If you really want to get a good deal, you're going to look at the 78.6 and the 88.6. Now you're asking yourself, okay, I understand 61.8, how you calculate it, the difference between the Fibonacci's, the 50%. Okay, I understand that. 38.2 and 23.6. Got it. Where do you get these numbers from? If you take 0.618 and square root it, you would get 78.6. If you want to pause the video now and pull out a calculator and do the square root of 0.618, you will get 0.786. And then if you take the square root of 0.786, you will get 0.886. And that's where we get these numbers. As we were talking during the Fibonacci section, these are turned into essentially percentages. So 23.6% is the discount that you're getting from these highs. So 23.6% off would be 15,734, and so on and so forth. Okay, so what Fibonacci is telling us is this 78.6 level, this is 6,483. This is the support that came in. So imagine not having this Fibonacci, right? Imagine, okay, we're looking at this without the Fibonacci, and this is a good example for people who say that Fibonacci doesn't work and it's smoke and mirrors, or it's just coincidence, or it's hocus pocus, or it's just a joke, right? You're looking at the price and you're seeing it. Let's go back. So you're seeing the price go up. You see it go to it's 9,000. Then it shoots up higher. It's going 10,000, 11,000. Oh my gosh, it's at 16,000. Back down, back up, back down, back up. Then we get 19,000, right? You don't know where it's going to go next. You really don't. A lot of people thought it was going to keep going through 20,000. Then we start to get a bit of a pullback. As the pullback's taking place, we're trying to figure out, okay, where do we get back in? And a lot of people, including yourselves, may be right now trying to figure out, where do you get back in? Where do you get back in? Okay, price is shooting back up, price is shooting back down, price is shooting back up, price is shooting back down. Now, if you would have placed a Fibonacci, I just have my shortcuts here, so this is a Fibonacci here. If you would have placed a Fibonacci way back at this point in time, oops, it's not gonna let me do it. Just bear with me for a sec. Okay, so if you would have placed your Fibonacci here, right? And this would have been December. This would have been in December. You place your Fibonacci from the lows in September up to the high, right? And you say, okay, I'm placing my Fibonacci. I know Fibonacci works. I just want to know where to get back in. In December, you would have known that the 61.8 is at 9,000. Okay? I've spoken to people who have said, and this was around January. No way, Marley. There's no way that the price can go from 13,000 to 9,000. I just don't see it happening. It's just not possible. I can't believe that. I would have said, because I'm a 78.6 and an 88.6 trader, I would have said, well, you better believe it, because I think the price is going to 6,500 because I'm a 78.6 trader. So in December, I would have said, I'm not entering back into Bitcoin until the price hits 6,500, because that's a 78.6, which is the 0.618 square rooted. And sure enough, price shoots up. And when these things happen, because I'm going to actually mention this while this is coming up here, as we're moving along in the timeline, you can see the price shot up from 12,000 to almost 17,000. And a lot of people would have jumped in here and said, okay, yeah, we're back in, we've seen the lows of 13,000, that's it. But if you're looking at Fibonacci's saying this is only a 38.2% reduction, the 38.2% sale on the price. We still have the 50% sale and the 61.8% sale and the 78.6% sale and the 88.6% sale that we haven't even seen yet. I mean, yes, we did see a bit of a pop down here. I think that would have been one day where the price dropped down to the 50%. But what about the 61.8? We haven't even seen that yet. So why are you jumping back in, putting all your eggs back in, your full life savings back in, when the price is so high? It's above this 23.6%. Let's look at the bigger picture. And then sure enough, what happens? Everybody's bought, and price continues to drop lower. We got a test at the 50% right there. Then we go lower, 50% gets broken. Then we see 61.8% gets broken. Then we see 78.6% gets broken. And it's these levels here where institutional investors are starting to basically make very small, calculated, technical purchases. The institutional investors are not buying here. The retail investors are buying here. The investors who are really not looking at the charts are buying here. The investors who are getting impatient are buying here. When you're patient, you have the ability to know not to look necessarily here at the price action, but to focus in on these key levels of the Fibonacci ratio. And you know that the price will come down to 61.8, almost with a certainty. And you know that once it hits the 61.8, or the 78.6 in this case, the risk is considerably reduced. And the chances are the price is going to reverse and go back up. You might be asking yourself, Marley, why don't you just pick one and stick with it? It's just too complicated for me. Well, sometimes it's not as simple as that, because as you can see in this downward leg here, we got a test of the 61.8, which happened to be 9,372, and the price shot back up, right? So at this time, if you're just focusing on here, on an hourly chart, let's say, you don't know if the price is going to go down to 78.6. You may feel like you've missed out. And so I like to kind of average in as the price goes down. I like to take a little chunk here. One of my friends calls it tranches. I like to call it taking a few bites at the cherry, or setting traps at various locations. And I like the word trap because you're essentially trapping the market and making it work for you, as opposed to you being ruled by the market. It goes back to that number 4 that I was talking about when developing your trading plan, when it comes to psychology and your mental stability. And it also ties in the quote, which is, while you're being patient. So from December, a lot of traders have being tested, or are being tested on their patience. And what are they doing? Some are watching YouTube videos blindly and trying to buy in when their YouTuber tells them to buy in. Other traders who are a little more informed and maybe a little bit more keen and curious, and maybe developing that experience that they need and applying screen time, are looking at creative ways to start finding the lowest risk possible for themselves. because if your YouTuber that you're watching is wrong, then you can't go to them and say, look, I just lost $4,000. Please give me my money back because I followed you. It just doesn't work. If you're able to analyze these markets and look at them from your own perspective and make your own informed decision, then that provides you with a wealth of knowledge that you can apply to any cryptocurrency or any instrument. You can apply this to currencies, you can apply this to stocks, you can apply this to anything across the board, and you will be self-sufficient and not dependent on someone else. All right, enough of that rant. So what we see here is a 78.6 trigger, boom. All right, and then this is a great example of how Fibonacci works in the real world. Okay, we got a low, we got a high, we have our Fibonacci. We place our theoretical buy at this 78.6, right? What happens? It's quite clear. I don't know how else to describe it. The price comes down to this 78.6. It triggers all these orders. Probably a lot of stop losses were triggered here from newbies and traders who really don't know what they're doing. And those sell orders, which would be the buyer's stop losses, are scooped up or sucked up or triggered by the institutional investors buy limit orders. And as you can see quite clearly, the price begins to rise. Okay, now where are we now? So when we did the video in February, we would have been right around, let's see, yeah, the video in February was about, yeah, somewhere around here. So when the video in February came out, we were at exactly in this area here, I think. Yeah, February 11th was the date. So we would have been right here on February 11th. Okay, February 12th, February 11th. And what we were saying was 5% of the account is going to be purchased. And this was Project Afro. I like to come up with cool names. Just this goes back to the quote: when you're being patient, come up with fun things to make it interesting, to make it engaging so that it's not so boring. A lot of people think trading is so sexy and trading is so exciting and adrenaline driven. A lot of it is just waiting around. A lot of it is looking at charts, building up screen time, doing examples, doing paper trading, looking at the other side of the trade. And that's something that we'll do very quickly in a few minutes. So one of the things that I like to do is name my entries. So Project Afro was at 7,000. So we put Project Afro here, okay, which is just about almost $2,000 below the market price on February 11th. Project Afro 7,000, and that was 5%. Then we did Project Bermuda at 6,000, which was 5%. And then we did Project Crypto, which was another 5% at 5,000. Okay, and Project Crypto was just around this 88.6 level. So we're getting in above the 78.6, below the 78.6, and just above the 88.6. 3 entries, which will end up averaging out 15% at around 6,000. So we'll end up with 15% at around this level here if all 3 are triggered. Now let's see what happened after that. And price went up. Now a lot of traders would chase the market. They'd say, oh shoot, we're out. I did a video on this and I'm wrong because the price went up and I'm not even in. I didn't get triggered, so my orders haven't been placed. So I don't know what to do. Okay, wait, the price is coming back down. Let's see, we're waiting. What's my behavior while I'm waiting? I'm still gonna wait it out. And in my head, I'm thinking, okay, this is all fat. This is inducing buyers to enter the market. And when you're inducing buyers, these are newbie, inexperienced buyers who are coming into the market at a high, and they're going to get stopped out. Or their buy orders are going to get sucked up by sellers who are going to short the market and bring the price back down. And that's essentially what happened. Buyers were induced and then pretty much reversed the price down back to where we were on February 11th. And that's where we sit now. Okay, so questions arise as to where do we go next? Okay, one thing that I want to add to this Fibonacci is where have we seen support in the past? Okay, so in the past, this has been a fairly strong support level. Okay, and I like to do boxes instead of lines. So if you just look underneath here, you can see these wicks, one wick, and you kind of see a little bit of a flattening there. So in between here is a very good support level. Okay, and this is not using Fibonacci. This is simply looking at what has happened in the past in terms of price. Okay, let's have another look at wicks here, and then this looks like a nice support. So we got 1, 2, 3, and then 4. So if we draw another support range kind of here, you can see that these are also levels that have been support in the past and potentially could be support levels in the future. Now, if we compare these red boxes to our Afro, Bermuda, and crypto, Afro is going to be right here. So if we break through this, we'll get Afro triggered at 7,000. If we come down here, this is essentially where Bermuda is. Bermuda's at 6,000. So the top end of this box is another 5% for our Bermuda entry, Project Bermuda. And then 5,000 is at the bottom end of this box, which is Project Crypto. So we're also using support levels from the past to kind of give us that added confirmation, or that added support, that added comfort. Comfort is so important when you're waiting for things like this. Okay, you're probably thinking, okay, how did you know that the price was going to go back down? I didn't. I knew that Fibonacci was telling me that these levels are levels of support. I did these structure, I call these structure levels, while I was waiting. So as the price was going up, I was still looking at, okay, where are these lows going to be? Because I want to get in at the lowest point possible. And as I'm being patient, I'm using my time productively. I'm looking at other entry points. Am I correct? Do you think that Afro, Bermuda, and crypto are going to get triggered? Why are they going to get triggered? What was the cause of this rise higher? And I literally sat on my hands. I didn't place any trades. I didn't make any adjustments that I thought were necessary in my outlook on February 11th, because there were so many signs in my trading plan letting me know that this wasn't the time to buy. This was not the time to buy. We still had to see another move lower. This red line is a support level, yes, but I see a drop lower because of this Fibonacci coming into play. I also see this red line crossing this yellow line as an indication that the price is going to go a bit lower. I see this red line getting closer to this green line, but moving averages, because of the downward move that we're seeing. This red box is a very important support level. So until I see the price come in here, I'm not looking to buy. Okay, I'm not looking to buy anything substantial. Now, if we break down towards Afro, for me, Afro is a fairly aggressive purchase level at 7,000. The more risk averse or more conservative or defensive levels that I'm looking at are Bermuda at 6,000 and crypto at 5,000. Also mention at this point that I had the stop loss placed at 2,500 if all of this is invalidated and the price just shoots down. Essentially, what you want to do when you're developing a trading plan is you want to try and bring as many things together as possible to affirm that your position is the best and lowest risk. So as you're being patient, you're looking for ways to either disprove or confirm your analysis and your outlook. And in this instance, our episode 11 video was confirmed by these support levels and also by these exponential moving averages. to wrap up this video, we're going to have a look at the chart that we created back in episode 11, and this is the places that we had placed for episode 11. These levels have already been placed. These green lines had already been placed, and yellow line and red line had already been placed. This was the level for Project Afro, this was Project Bermuda, and Project Crypto. I haven't the only thing I've done to these are move them to the right. Okay, so I've moved them from where they were on February 11th. They were here, so they would have been here, here, and here. Just didn't make sense to keep them there because the price went up. So I've just moved them, let's say, a month and a half to the right. Okay, we have our stop loss down here at 2,500, and we are reaffirming that our outlook is to purchase 5% in Project Afro at $7,000 per Bitcoin, to purchase 5% at $6,000 per Bitcoin, and we're calling that Project Bermuda, and to purchase the last 5% in this 15% accumulation of Bitcoin down at $5,000 per Bitcoin, and our stop loss is 15% at the price of $2,500 per Bitcoin if the price does drop dramatically lower as a result. Thanks so much for watching. Don't forget to like the video and don't forget to subscribe. Please take a moment to write us a comment, share this video with family and friends, and follow us on social media. All of our social media links are conveniently provided for you in the description. And I'm finally now on Instagram. Make sure to follow me, Marley Holiday. If you've been thinking about investing for a while, but never had the time to actually figure it out or sit down and set it up, or maybe you have some questions on this video that you don't feel comfortable posting on the YouTube comment section. Maybe you're looking at getting a trading coach. You've already started, but you want somebody to help you navigate through your trading journey. Please email us at info@signaturefxa.com. This email address is also provided for you in the description. We'll be happy to help you out. With that, I'd like to thank you for your time and attention, and until next time, happy trading.